What if one man could build empires and destroy them just as easily? Carl Icahn didn't just take over companies, he rewrote the rules of corporate America, but was he a visionary or a villain? Stick around, because the truth might just change how you see business forever. What if I told you that one man, armed with nothing but his wallet and his wits, could dismantle billion-dollar corporations, shake up entire industries, and walk away richer every time? You might think companies are too big to fail, too secure to be torn apart. But what if there was someone who saw opportunity in chaos? A man whose very name could strike fear in boardrooms? That man is Carl Icahn, the corporate raider turned Wall Street legend. His hostile takeovers made headlines, made fortunes, and made enemies. But here's the big question. Was Carl Icahn saving companies or destroying them for profit? Stick around to the end of this video, because we're going to break down Icahn's most infamous takeovers, the controversies that followed, and the undeniable impact he had on corporate America. By the time we're done, you'll decide for yourself. Is Carl Icahn a brilliant empire builder or the ultimate corporate villain? To understand Carl Icahn, you need to go back to where it all began. Queens, New York, 1936, a working-class borough far removed from the shiny towers of Wall Street. Carl Icahn was born into a middle-class Jewish family during the tail end of the Great Depression. His mother was a school teacher who instilled in him a strong work ethic, while his father, a cantor, spent years dreaming of something bigger, but never quite achieved it. These early experiences taught Carl a lesson he'd carry for the rest of his life. If you want something, you have to take it yourself. Even as a teenager, Icahn showed glimpses of his future self. While other kids were playing baseball, Carl was studying poker strategy, a game that requires not just luck, but precision, analysis, and the ability to read people. He played regularly and rarely lost. Not because he was lucky, but because he understood how to exploit weaknesses and use leverage, skills he'd later bring to the corporate world. Carl's brilliance took him to Princeton University, where he majored in philosophy. You might not expect a future Wall Street legend to study existential questions, but Carl loved analyzing logic and power, concepts that would define his career. He once joked that studying philosophy taught him how to deal with CEOs who speak in riddles. After graduating, Carl spent 2 years in the Army, an experience that hardened his resolve. In 1961, he began his career as a stockbroker on Wall Street. But Carl wasn't like other brokers. He didn't just sell stocks, he studied them, constantly looking for opportunities that others overlooked. By the late 1970s, Icahn had saved enough money to start his own firm, Icahn and Company. He was no longer a small-time stockbroker, he was a player. But Carl saw something that others on Wall Street were blind to. He realized that many companies were undervalued. Their stock prices didn't reflect their true worth. CEOs were careless, wasteful, and often asleep at the wheel. Carl knew that if he could buy enough shares, he could take control of these companies and force them to unlock value. And just like in poker, Carl Icahn played his cards with confidence and precision. He wasn't afraid to raise the stakes, and he was about to change Wall Street forever. His first major test? TWA Airlines, a company on the brink of collapse, and an opportunity Icahn couldn't resist. It was 1985, and Transworld Airlines, TWA, was a shadow of its former self. Once one of the largest airlines in America, TWA had been struggling for years. Competition was fierce, operating costs were skyrocketing, and management was failing to turn things around. For most investors, TWA was a sinking ship, but for Carl Icahn, it was an opportunity. Carl wasn't looking for stable, thriving businesses. He wanted vulnerable targets, companies he believed were undervalued and badly managed. TWA fit the bill perfectly. Icahn began his move quietly, as he often did. He started buying up shares of TWA, flying under the radar while Wall Street remained distracted. By the time management realized what was happening, Icahn had already secured a significant stake in the company. This is what's called a hostile takeover, a move where an investor seizes control of a company without the approval of its leadership. TWA's board fought back, but Carl wasn't playing games. He made his intentions clear. He would take over and fix TWA. Once Icahn had control, he implemented his now infamous strategy: cost-cutting. He slashed expenses wherever possible, from employee wages to maintenance budgets. Asset-stripping Icahn began selling off TWA's most valuable assets, its prime routes, terminals, and airplanes, to generate quick cash. Leveraging debt, Icahn loaded TWA with enormous amounts of debt to fund his plans, taking payouts for himself and his investors. On paper, TWA looked like it was improving. The company's stock price rose and shareholders saw quick gains. But underneath the surface, cracks were beginning to show. Icahn's fix came at a cost. By the early 1990s, the consequences of Icahn's strategy became clear. Stripped of its most valuable assets and drowning in debt, TWA's ability to compete had been crippled. Employees suffered the most. Thousands lost their jobs as layoffs swept through the airline. And Icahn? He walked away with hundreds of millions of dollars, richer than ever. Carl Icahn defended his actions. In his view, TWA was already doomed before he arrived. He claimed that by unlocking value and returning money to shareholders, he had done his job. But critics saw things differently. To them, Icahn hadn't saved TWA. He had bled it dry for his own gain. And this wouldn't be the last time Carl Icahn would face this accusation. With TWA behind him, he would go on to target bigger companies, sparking debates that still rage today. Was he a savior or a corporate predator? Carl Icahn didn't just stumble upon his success. He developed a ruthless and calculated strategy that would become the blueprint for hostile takeovers. A strategy that companies feared and investors admired. Here's how the playbook worked. Step 1. Identify a weak target. Icahn didn't go after thriving companies with strong leadership. He hunted for vulnerable businesses, companies with undervalued stock, bloated management, and inefficient operations. In Icahn's eyes, these were opportunities to unlock hidden value. He looked for fat companies, those that spent too much, moved too slow, and operated with outdated leadership. For shareholders, Icahn promised big returns. For CEOs, he was their worst nightmare. Step 2. Buy shares quietly. Icahn's moves were surgical. He began by accumulating shares quietly, keeping his actions under wraps. This was key. By the time the company realized he was buying in, it was already too late. Once Icahn secured enough shares to hold power, typically 5 to 10%, he became a force that management couldn't ignore. When corporate boards saw Carl Icahn on their shareholder list, panic set in. A former CEO once said, "When Icahn buys into your company, you don't just worry about your stock price, you worry about your job." Step 3. Take control and demand change. Once Icahn had enough shares, he went to war. He forced his way onto the company's board. He demanded changes, cut costs, sell assets, replace leadership, or even break up the company entirely. Icahn's mantra was clear. If a business isn't making money for shareholders, it's failing. And if leadership won't act, he will. Take Blockbuster Video, for example. In the early 2000s, Icahn bought a massive stake in the company and forced his way onto the board. He pushed management to focus on physical DVD rentals rather than investing in new technology. The result? Netflix swooped in and revolutionized entertainment. Blockbuster, once a giant, collapsed. Then there was Texaco, the oil giant. Icahn's intervention came at a critical moment. Texaco was embroiled in lawsuits and losing investor confidence. Icahn pushed for settlements, leadership changes, and restructuring. While shareholders made money, Texaco's internal stability crumbled. Step 4. Cash out and walk away. Finally, once Icahn had driven up the stock price and extracted value, he sold his shares, often for hundreds of millions of dollars. Icahn's focus was always on short-term gains. But here's the rub. While Icahn walked away richer, the companies he targeted were often left weaker than before. Employees lost jobs, divisions were sold off, and in many cases, the businesses never fully recovered. To Carl Icahn, this was business. To his critics, it was destruction. And yet, Icahn kept winning. His playbook made him billions and turned him into a legend. But here's where things get even more interesting. Carl Icahn wasn't done. With every success, his reputation as a corporate raider grew, and his critics grew louder. Was Icahn fixing broken businesses, or was he simply playing a game where only he could win? Carl Icahn never shied away from controversy. To his supporters, he's a hero, a truth-teller who exposed corporate greed and waste while making shareholders rich. To his critics, he's a predator who gutted companies, destroyed jobs, and walked away with billions. But here's the thing, Carl Icahn doesn't care what you think of him. In his words, if you want to make friends on Wall Street, buy a dog. Carl Icahn built his reputation on a single core belief: shareholder value is everything. To him, companies exist to serve their owners, the shareholders, and not to prop up inefficient CEOs or outdated business models. Icahn argued that most companies he targeted were already failing before he arrived. The leadership, he claimed, was asleep at the wheel, wasting resources, ignoring opportunities, and failing to innovate. I'm not the one putting these companies in trouble. I'm the one exposing their problems. If I didn't step in, they'd go under anyway. Take RJR Nabisco, a massive food and tobacco conglomerate. Icahn targeted the company in the 1980s, arguing that its management was overpaying for flashy acquisitions and ignoring the company's core value. Icahn's involvement led to a bitter battle, but in the end, shareholders made huge returns. To Icahn's supporters, this is proof of his brilliance. He forces companies to face their inefficiencies, cut the fat, and deliver real value to investors. Without him, these businesses would remain bloated, stagnant, and headed for collapse. But not everyone buys Icahn's defense. To his critics, Carl Icahn isn't saving companies. He's bleeding them dry for personal gain. Icahn's strategy often prioritizes short-term profits over long-term sustainability. He's been accused of stripping companies for parts, cutting jobs, and saddling businesses with crushing debt, all to drive up the stock price quickly. After Icahn leaves, these companies are often left weaker, smaller, and struggling to survive. For employees, Icahn's arrival often meant layoffs, factory closures, and shattered livelihoods. Look back at TWA Airlines. Icahn sold off its most valuable assets to generate immediate cash, but in doing so, he crippled its ability to compete. Within years, TWA filed for bankruptcy, and thousands of employees were left without jobs. Critics point to examples like this and ask, is Icahn really unlocking value, or is he just extracting wealth at everyone else's expense? This is the paradox of Carl Icahn. For shareholders, he's a champion, a man who forces companies to answer to their owners and deliver profits. For employees, executives, and critics, he's a wrecking ball, someone who tears businesses apart for personal gain. And here's the truth. Carl Icahn doesn't apologize. To him, business isn't about feelings. It's about winning, and Carl Icahn always plays to win. But the debate still rages on. Is Carl Icahn the hero who exposed corporate corruption and laziness? Or is he the villain who profited off the destruction of American businesses? One thing is certain. Carl Icahn didn't just change companies, he changed the game, and his legacy will always divide opinion. Love him or hate him, Carl Icahn's fingerprints are all over the modern business world. He didn't just target companies, he fundamentally changed how they operate, how they're managed, and how they view their investors. Corporate accountability, forcing CEOs to answer to shareholders. Before Carl Icahn, the relationship between company leadership and shareholders was often out of balance. CEOs could run companies however they liked, overpaying themselves and executives, spending recklessly on unnecessary expansions, and ignoring shareholders while stock prices stagnated. Icahn changed that. When he arrived on the scene, CEOs knew they were under a microscope. Icahn forced boards to justify their decisions and prioritize shareholder value over everything else. Suddenly, underperforming companies couldn't hide behind business as usual. Take Motorola. By the mid-2000s, the tech giant was floundering. Icahn stepped in and demanded radical changes, including spinning off parts of the company. Motorola resisted at first, but in the end they broke into two companies, unlocking billions in value for shareholders. This became Icahn's signature move: put pressure on companies, force hard decisions, and drive up stock prices. The rise of activist investors. Carl Icahn paved the way for a new breed of investor, the activist investor. Before Icahn, most investors simply bought stock and hoped for a return. Icahn showed that by taking an aggressive stance, buying large stakes, pushing for change, and taking control, investors could reshape entire companies. His success inspired others like Bill Ackman, Dan Loeb, and Nelson Peltz, who adopted similar strategies. Today, activist investors are a powerful force, keeping corporate leadership accountable and forcing innovation. Even when Icahn isn't directly involved, his influence is felt. The mere threat of a hostile takeover forces CEOs to clean up their operations and keep shareholders happy. Boards think twice before overspending or ignoring their investors, because they know someone like Carl Icahn could come knocking. A fearsome reputation. Icahn's name became a symbol of power and fear. Corporate executives dreaded hearing that Icahn was buying shares of their company. It meant change was coming, whether they liked it or not. One CEO famously said, "When Carl Icahn gets involved, you're not just fighting for your company, you're fighting for your survival." And yet for shareholders, the sight of Icahn was often a relief. His reputation for driving up stock prices meant investors could cash in big, sometimes earning millions from his interventions. The double-edged sword. But Icahn's legacy isn't without controversy. While shareholders often profited, critics argue that Icahn's short-term focus weakened businesses in the long run. Companies stripped for parts, burdened with debt, or broken up rarely emerge stronger. For every success story like Motorola, there's a cautionary tale like TWA Airlines, a company left in ruins after Icahn extracted its value. This is the double-edged sword of Carl Icahn's legacy. On one hand, he forced businesses to be more efficient and accountable. On the other, he sometimes left destruction in his wake, with employees paying the price for corporate efficiency. Regardless of where you stand, there's no denying that Carl Icahn changed the game forever. He exposed corporate waste, shook up leadership, and showed the world that companies had to answer to their investors. He inspired a new generation of activist investors, keeping CEOs on edge and boards in check. Carl Icahn didn't just build empires or break companies, he forced businesses to evolve, adapt, and survive in a world where inefficiency was no longer an option. And that's why Carl Icahn's legacy is so divisive. To some, he's a hero who saved companies from themselves. To others, he's a villain who profited while businesses crumbled. But one thing is certain, Carl Icahn's influence will be felt in boardrooms for decades to come. So here we are. Carl Icahn's hostile takeovers made him billions. He exposed wasteful leadership, shook up corporate America, and forced change. But at what cost? For shareholders, Icahn was often a hero. For employees and struggling businesses, he was the villain who pushed them over the edge. Here's the truth. Carl Icahn didn't just build empires or break companies. He changed the game. Whether you see him as a genius or a predator, his impact on business is undeniable. So what do you think? Was Carl Icahn saving companies or destroying them for profit? Drop your thoughts in the comments below, and let's get the debate going. If you enjoyed this deep dive into the titans of business, hit that like button, subscribe, and ring the bell so you don't miss our next story. Thanks for watching Pioneers of Profit, and I'll see you in the next video.